Good morning, Emily.
Good morning, Dan.
All right, what are we talking about today?
Who needs a financial planner? How to select a business structure and what decisions need to be made with that, and an overview of annuities.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Who needs a financial planner? How to select a business structure and annuities? Okay, well, clearly the answer is everyone. The best business structure is whatever makes you pay the least taxes, but also preserves the most value. And annuities are a mixed bag. So that's it. Good podcast.
If only it were that simple.
It'd be nice, but I don't think it's going to work out for us there. All right. You cannot just be asking who needs a financial planner just as a general question. There's no way that's your question. So why ask?
Well, per usual, I'm pulling from my experiences in personal life, as I love to do for the podcast. And recently, within the last week, I would say, multiple people from my personal life from all different areas of it have suddenly kind of realized what it is I do for a living. I think, everyone knows your job title and they're like, oh yeah, that's what you do. But it's either been a combination of not realizing the full scope of what I do or how in depth it is. And I've suddenly been inundated with questions and people who think, oh, maybe I actually do need to hire you as a financial planner.
Yeah, that does happen. I remember when I got started originally, there were two things. There was something to do with a Chinese trade issue that people got really concerned about for 5 seconds, and then Brexit happened around that time. And those two events were sort of magical moments when suddenly all my old coworkers and people I knew from the Army and whatnot were suddenly texting me or calling me or emailing me to Dan, what do you think about this? What should we do? And I was like, well, hold on, where have you guys been the rest of the time I've been telling you what I do for a living? Suddenly you want help now there's a crisis? I see how it is.
Yeah, of course. In the early days when you're looking for more clients and just starting out, they're nowhere to be found.
Yeah. So such is life for all new businesses. So, is it the market crash stuff that's been happening the last couple of days that's driving this, or is something else happening? Give me some context.
Surprisingly, no. I definitely get questions from people, and they just kind of do the arm punch thing, where they're like, "Yeah, things are crazy, huh?" And then they move on. It's actually been a larger amount of people asking or coming to me and saying, okay, so, I've kind of understood what you're doing and what you have been doing at this job, but I didn't think I was a big enough fish, is kind of the phrase I've been hearing. I was going to reach out to you in a few more years when I have more money to play with, or I feel like I have a little more wiggle room, and then I was going to hire you.
Yeah, that's a pretty common one. And a big reason that drives that is most people have never had a financial planner or financial advisor. And I think there's two sort of interesting dynamics to that. There's the bad conversation you've had with one before that leads you to think that you're sort of inadequate as a client, or there's the moving goalpost problem.
Yeah, I think it's been more the second one for the person I'm thinking of in this instance, actually. They're like, well, I don't need that. I don't have enough money invested. And they definitely thought that investment management was a larger piece of what we do, when in fact it's closer to about 1/7 of what we actually do. And they said, well, we don't have a lot of big investment accounts. So, what can you do for me?
The other 6/7, obviously.
Yeah.
The interesting thing about it, because I'll describe the two problems in a little bit more detail. The bad first conversation is one that a lot of people in my life had dealt with when I was getting into the industry. Part of onboarding as part of the Waddell and Reed firm back in the day, they had you interview people in your family and friends and network. And from their perspective, that was more of a business development thing, but they didn't make that clear to me. So for me, that was actually just informational interviews. Hey, what do you know about financial advisors? And is this a good career for me? And the feedback I got from a lot of people was yeah, I got a bonus once, and I went to the bank, and there was a guy in the bank, and I said, I want to invest my bonus. And the guy at the bank was like, great, how much is it? And I was like, I've got $5,000. And the guy in the bank was like, that's not enough, go away. And that was an experience a lot of people in my family and kind of my community growing up had dealt with over the years. So they had just sort of learned to do without. And that's obviously had a lot of issues for the folks who then never got invested, never got help. But the moving goalpost thing that you're describing is always interesting, because I've heard people who genuinely have nothing, right out of college, say, I don't have anything, I don't need a planner. And Like that's probably about as fair a case as I can get. I think there's a lot of planning opportunities there, but like if you literally don't have any money to pay for a planner, like fair enough, man. I can't like force you to take blood from a stone here. But on the other end of that, I've had people who have like $3 million, $4 million, right, or own a business that's doing $100,000 of profit for them a year plus their salary they pay themselves for another 100,000. Be like, I don't know, I don't think I've got enough, and it's like, no, you're absolutely appropriate for this. I mean, we work with teachers, we work with people who are single, married, divorced. We work with people starting over, people who've gone bankrupt. There's all sorts of people that we work with as financial planners. So it's not, there's no bright line of like, I don't make enough money, or I don't have enough money in investment accounts, because there's a financial planner out there for everybody in every life circumstance. And so, to the core question of the whole like, who needs a financial planner? Anybody who needs help with their finances needs a financial planner. It's just a matter of finding the right financial planner for you.
Right. And I think, I mean, another common kind of pushback I get from people is like, well, my situation is too simple. There's not enough you can do. It's like, well, maybe you're just not aware of all the things that we can do. And it's quite possible your situation is simple and will remain simple, but also maybe isn't quite as much as you think it is.
Simple is always fascinating because our situation tends to come across to us as simple because we are so familiar with it. So we go like, well, I know what my job is, I know what my spouse's job is, I know how much money I've got in the bank, I know where our income comes from. You know, I know what our situation is. It just doesn't seem that complicated. And that joke is among financial planners, but also there's a joke among tax professionals where a person will go to a tax preparer and say, "My situation's super simple. I just have used to be a child movie star, so I've got royalties, and I own a dairy farm in Romania, and I have 3 jobs and 9 side businesses. Super simple." Right. Like there's this funny thing where we tend to sort of discount the complexity of our lives. But also, let's just be really honest about this. Let's take an analogy from medicine here, for example. If you're not a medical expert, do you know at face value how healthy you are? Like, you know how you feel, you know what functionality you have or don't have, you know what conditions you have or don't have. But unless you're actually running, impartial diagnostic tests, and you're, getting lab results, and you're doing, exams and screenings and all sorts of things, you just sort of have an approximation for how you are. You don't know if you're healthy or unhealthy, or if there's a problem lurking beneath the surface. So when somebody says my situation is simple, what they may actually be inadvertently and unknowingly covering up is a serious problem in their financial situation that they're just completely unaware of because they have no context with which to assess that problem.
Oh, that actually applies a little bit, quite a bit actually, to the person I was thinking of in our earlier part of this conversation, where it's like, yeah, your situation is very simple because there's a lot of things that you're not doing that you should be doing that would then make it much more complex.
Well, and in that particular regard as well, I think a common pushback we get similar to that is somebody who's like, I've got a good portfolio, so what are you going to do for me? And that's somebody who's sort of focusing in on the 1/7 of investment management and being like, well, if I'm making money in my investments, what do I need you for? And, I found a lot of people don't actually have a good portfolio when they say that. They just think they have a good portfolio. But take that aside, right? That says nothing about your taxes, your estate, your risk management, your cash flow, whether you have an optimal stream of income as from a tax perspective, both short and long term. And are you performing activities every year that are going to net out the best long term outcome for you? Or are you doing well in short measurements like this quarter, this year, next year?
Right. And I think some people think that they have those other elements covered and they only need help with investments. Like I've spoken to several people and they say, well, my tax planning stuff is taken care of. I have this great CPA that I work with. He files my taxes for me every year. I get a big refund. I don't need any help with my tax planning.
This is probably where the biggest conflict between financial planners and tax professionals comes up. And I'm going to speak generally here. I can think of a dozen exceptions to what I'm about to describe. So if you think you're an exception, please don't email me with a nasty gram saying that you're different. I'm sure you are. I'm not questioning that at all. But there's a common push-pull between tax preparers and financial planners, which is that tax preparers fundamentally provide a compliance service first and foremost. Are you reporting your income and your deductions and claiming credits appropriately, so on and so forth, in the current year? And that supersedes everything, because if they're signing on the tax return, they are stating essentially under criminal penalties that this information is accurate. And that often then leads them to be assessed. They get conditioned to being assessed by their clients based on whether their clients get a refund, or if they're more ethical and serious, they say, like, look, getting a refund is not a guarantee. You either will have taxes owed or you will get a refund based on overpayment or eligibility for credits. But I don't decide that. That's just a matter of correctly reporting what you've done so far. And in that situation, a lot of them become sort of risk averse to coming to clients and saying, sorry, you've got a really big tax bill. And they tend to try to focus on doing everything they can in the current year to get any tax bills either reduced or eliminated. And the consequence of that then is that they might be doing really great single step tax planning, right, or tax preparation work, but they're failing to address the long run. In turn, as financial planners, we often make a mistake where we're like, hey, this strategy is going to work great over the next 20 years. And the tax preparer is looking at us going like, yeah, but I have to tell them that they're going to owe $9,000 this year because you did a bunch of conversions or something and it's costing them a bunch of money, and they're going to yell at me. So that's where, again, you can be doing specific finite things really, really effectively. You can even have a great professional team behind you helping you do awesomely at a specific thing. But the role of a financial planner is to look at where we are today, where we're trying to get to, and to analyze and assess and forecast what's going to happen over years or decades. And sometimes that means that short-term optimization is creating long-term problems.
Right. And I think that's an important call out of why we then work hand in hand with people if they have a CPA. Their CPA can be part of our, Q1 meeting with review tax documents and stuff. We like to work together with them. We don't replace them and they don't replace us. You kind of need both ends of that spectrum there.
Yeah. And I mean, just keeping in mind, folks, the day that this comes out, it's going to be just a couple days past the corporate tax deadline. So if you are sitting around fuming that your tax preparer hasn't gotten you your tax return yet, take a chill pill. You got a whole another month before April 15th rolls around. And if they extend you, I promise it's not going to be a big problem for you. But in that particular sense, the thing I have to sort of point out in the context of who needs a financial planner is just to take a game analogy. Do you play something like a game of chess one move at a time, or do you win a game of chess by thinking several moves ahead? And that's the really important thing here is just because nothing's wrong now, just because you're not losing now, just because things are okay now, doesn't mean things are going to work out over the long term. And that's where a financial planner is really great at being able to assess how things are today and how things are going to look in the future, and whether or not course corrections or improvements can be made.
Sure, that's that analogy that I hear used all the time where, you're not drowning, but you're also not swimming competitively. And I think that's my favorite one because it's very short and simple and illustrates it really, really well.
Yep. I was going to say, like, if you're not broke, you're okay for now.
Yeah. All right. Well, and I don't know. I guess one other little piece is like, I think people aren't sure if they need a financial planner because they they just don't know what they don't know is also kind of what I've been encountering this last week. They don't know what to ask. They don't know what they need. They feel a little embarrassed to ask, just I kind of want this thing here, but I don't know what it's called. I don't know how to even describe it. I don't know what terminology to use. And they're intimidated and they just don't come to you and ask because they know that you do it all day, every day. And they're worried you're going to think they're, I don't know, uneducated or something, which is so not the case.
Well, and yeah, I think that's an insecurity. I think a lot of people feel like they should know money stuff. They should know financial stuff. It's not uncommon for people to be embarrassed. They're like, I run a very successful law firm, but like, to be honest, I don't know anything about taxes. And just to come out and say that is a really big step for them. But on the other side of that, like, look, imagine if you went to your therapist and your therapist just looked at you on day one and said, like, man, you're really fucked up. Like, that's not what it's going to be like. That no professional is going to do that to you, or if they do that to you, they're assholes. I can think of a million other analogies, right? Going to a personal trainer is like, man, you're fat. Like, yeah, why do you think I'm here? Like, it's okay to not be in an optimal place when you go to a professional. The thing you have to do is just have enough trust and confidence in them to ask for help, and then they have to reward that trust and confidence by not making you feel bad about whatever may not be optimal, because they make a living making things optimal. And if they couldn't make things optimal for you, well, then what do you need them for in the first place?
Yeah. Yeah. It's an ongoing relationship with a lot of trust to have a planner.
Yeah, or a therapist or a lawyer or a good tax preparer, right? But at the end of the day, we're all here to try to make your life better in some way, shape, or form.
Yes. Very exciting concept. And with that, I'm on to my second topic. You know how I like to switch.
You
Okay.
have the world's worst transitions. I love you for it, but like, there's no flow whatsoever, topic to top. You're like, all right, bookmark in, closing the book, next book.
Yeah. Once I'm done with a project, I'm so done. I'm over it and I'm never looking back on it. I want to move on to the next challenge.
All right, next challenge it is. Hit me.
All right. Now we're talking about business structure and decisions around that. So, as a new business owner or someone in their first few years of being a business owner, some of this applies to either one. One of the first decisions they have to make is, do they want to be like an S corp, a C corp, this whole structure of it when they're setting up everything. How do they decide which one they should be? What's best for them?
Well, so let's just answer what the default is. If you start a business and you don't do anything formal whatsoever, you just start doing stuff and people start paying you for it, then the default structure is that you are going to be a sole proprietorship. A sole proprietorship is going to be a pass-through tax treatment, and that's an important phrase. What that means is all essentially at the end of the year, all of your profits or all your revenue are going to have all your expenses subtracted, and the net number at the end is going to be your tax outcome. So if you sell $100,000 worth of stuff and it cost you $80,000 to sell it, you've got $20,000 of profit. That's your income. That's what you're going to pay taxes on. The next step from that, if you have partners or other people who are involved in the business, is a partnership. Same thing exists here, except now we're going to divide up the numbers at the end of the year based essentially on the percentages of ownership, right? Whether you're 50-50 owners or 30-30 and 40 or whatever it is. So same sort of treatment there. And then outside of partnerships, outside of sole proprietorships, we get into corporate structures. You see a lot of people starting new businesses who read on the internet that doing an S corp is going to save them a lot of money in taxes, which I'm sure you're going to ask me about it, so we'll come back to that. But there are a lot of problems there. And then finally, if you have like a big, what I'll call like a real, genuine, robust business that's much bigger than the sum of any individual effort and owner, then you end up doing a C corp. And a C corp is going to be the sort of the largest, most formalized structure for a business. It's a very defined entity, separate from its employees. Its owners receive profits, but the business is taxed before they receive profits. There's a double taxation issue. But all of these different structures really just come back to what is tax treatment, and then what are the mechanisms of control, and how does money flow from the activities of the business to the employees and to the owners of the business.
Okay. All right. Well, and once you pick one or the other, is it hard to switch? Like if you start as a sole proprietor and then your business grows and changes and you decide you want to be an S corp or something?
It's only as hard as it is to engage the appropriate legal and tax counsel to make the change. So essentially, nobody's going to stop you from making the change to, let's say, go from a sole proprietorship to an S corp, or to go from an S corp to a C corp or something like that. It is much harder to kind of go down in complexity than it is to go up in complexity. So like going from a sole proprietorship to an S corp is not terribly difficult, but going from a C corp to a sole proprietorship is an enormous lift. And there can be really substantial legal and tax ramifications to doing it. So it's not like just waving a wand. The other thing that you'll often also hear people say is like, well, I'm an LLC. When you tell me you're an LLC, that means nothing. Like literally, that means nothing from a question of tax or from how you get paid, because an LLC is simply giving you essentially corporate tax structure liability protection in that the business is then a legally distinct entity separate from you as the owner. But that says nothing about your tax treatment and so on. And also, an LLC is not impervious. You see a lot of self-employed people who are legally tax-wise a sole proprietorship do an LLC, but then they're paying for like their car and their cell phone and a lot of meals and all sorts of personal stuff through the business. And any sufficiently talented plaintiff's attorney that ever sues that business is going to be like, look, this is actually really just a slush fund for the owner. There is no LLC. It's not real. So we should just do away with that, and now I can get at the owner's personal assets.
Oh, so you're not nearly as separate and protected as you probably think you are, depending how you're going about things.
Well, and that's sort of the key distinction here. A lot of people start a business as sort of a hobby or as a personal interest or as a side hustle. And so since all the effort of the business flows through their personal effort and all the income and expenses flow through from their activity, it's very easy for them to get lazy about the distinction between their personal activity and their business activity, and to just go ahead and treat their business accounts like a slush fund. And that's fine insofar as you have income. But then the problem is that if you're not paying that out to yourself separately as as the owner or separately as the employee of the business, you're really creating a problem where, again, any sufficiently motivated and talented plaintiff's attorney is going to get those records and say, like, look, so many personal expenses are buried inside the business. The business isn't really a distinct entity. And therefore, all the liability protection that having something like an LLC or an S Corp or a C Corp normally provides shouldn't apply in this case.
Very important to know. Let's circle back though a little bit to that S Corp taxation thing. Why do so many people think that it's more optimal from a tax standpoint to have that S Corp?
So the key distinction here is in payroll tax in particular. So everybody here who's listening who has a W-2 job, you are paying essentially 7.65% of your income. You're paying 1.45% to Medicare, and you pay that on $1 to dollar infinity of any wages you earn as a W-2 employee. And then you're paying Social Security tax, which is 6.2% on every dollar up to about $176,000. And that's an individual amount. So if your spouse earns $176,000 and you earn $176,000, you're both paying 6.2% on that all the way up. When you're self-employed, you have to pay that twice, because when you're a W-2 employee for a business, the business pays the same amount of taxes on your wages on the other side, but they don't charge it to your payroll. It's just an extra tax on top of that. So essentially, everybody's salary costs the business no less than 107.65% of what their actual salary is, because they have to pay these extra taxes on top of it. And when you're self-employed, you get to pay both of that. So instead of paying 7.65%, you're paying 15.3%. So the reason that people think that S Corps are magic tax shelters is that company profit, right? So distributions of actual profit from an S Corp or a C Corp for that matter are not subject to payroll tax. They're not earned income, so they're not subject to the Medicare tax. They're not subject to the Social Security tax. And so all things being equal, if you have somebody who, let's say, has $100,000 of profit in a sole proprietorship versus $100,000 of profit in an S Corp, in the sole proprietorship, you're going to end up paying $15,300 in these payroll taxes. And in the S Corp, on the $100,000 of profit, you're not going to pay $15,300. So everybody just looks at it and goes like, oh, the S Corp is superior. But there's a big problem with that.
How often would you say you have to kind of explain all of this to people?
Every single time. Because as I said, there's a big problem with the S Corp thing here. That scenario presupposes that in the case of the sole proprietorship, it's all pass-through income, so it's all earned income, therefore you have to pay the payroll taxes on it. In the S Corp, the problem is this. People go like, oh, if it's S Corp profit, I don't have to pay taxes. Sick. I'm just going to do that, and then I'm going to save myself 15.3%. But S Corps and C Corps, right? If you're the W-2 employee of an S Corp or a C Corp, because it's not just a purely pass-through entity the same way that a sole proprietorship is, you have to be paid as an employee of that business, and that creates a requirement to pay yourself reasonable compensation. So when you're a sole proprietorship and you use an S Corp structure, depending on the nature of your business, it can be really hard to argue that your business makes any money that is not derived from your efforts as the employee of the business. So like if you have a car detailing business and you're an S Corp and you're the only person who works in the business and you clean and detail every single car and all the revenue is attributed to your physical effort, it's really hard to make an argument that any of what you make in that business is profit and not just earnings and wages attributable to your work and labor. Now, if you have a business where you have certain activities that are passive, where you don't actually really do anything for it, but like you have royalties or you've done certain creative endeavors or something where you get paid sort of passive income to that business, then that might be a better case for passive income. Or if you have employees, you can start to argue that a portion of the revenue and profits of the business are attributable to the efforts of employees that aren't you, and therefore there are actually profits in the business. But if you don't pay reasonable compensation, what that can result in is pretty significant tax penalties, not only because you're going to have to pay all the taxes you should have paid in the first place, but also because it's treated as a form of fraud, right? Potentially, depending on how serious it is. So then there can be additional assessments, penalties, and fines for it. And so what we often see is a problem where, let's say you have like a realtor who's completely self-employed, who does an S Corp, and they're like, cool, I'm not going to pay a lot in self-employment taxes. I'll pay myself a salary of $24,000 a year, which no successful realtor is living on $24,000 a year. And then I'm going to sell $400,000 in commissions for houses and transactions. And then I'm going to pay the rest of myself as profits. And again, from an audit standpoint, my question here is, well, hold on. Let's say you've done $400,000 the last 3 or 4 years. You've never had employees. It's all from your work. It's all from your effort. It's all from your labor. So how is this profit versus just effort attributable to your labor and wages? And also, is $24,000 reasonable compensation for somebody who's producing $300,000 or $400,000 in revenue every single year based on their service business? It doesn't make any sense. So that's where the problem comes in with S corps, and it can also apply in C corps. But by the time you get to a C corp, you're robust enough and you've got the help enough to not make this mistake. But you see it a lot in S corp. People pay themselves no salary, which is just a complete no-no, or they pay themselves a completely insufficient salary relative to the type of work they do. So like a software developer paying themselves $20,000 a year when a software developer would be making, $150,000, $200,000 a year, or the owner of a company, even with employees, paying themselves a salary of $20,000 a year when all their employees are making $50,000, $60,000, $70,000 a year. All of these things are obvious tax dodges that are ultimately going to blow up in somebody's face when they go through an audit.
Hmm. How often would you recommend that someone kind of reevaluate then and look at their own compensation and possibly adjust it? Is it like yearly good enough?
You need to benchmark it yearly because you need to look at not only what is fair compensation for the work you do in your business, but also what is an industry norm. So if it's normal for people as W-2 employees doing what you do as a lawyer or as an accountant or as a drywaller, like whatever your business is, you need to pay yourself reasonable compensation relative to industry norms. Now, if your business can't afford it, right? Like if you're a brand new business and a person with your job in this industry normally makes 80 grand a year, but the first year you only do 40,000 in revenue, you don't have to invent wages that don't exist for this purpose. Like there's an obvious you can only pay so much as you have principle here. But the big problem is a lot of people do this S corp election, pay themselves nothing as a salary, take everything as profits, and then eventually they pay themselves a piddly salary, take the rest as profits, and ultimately they're going to get in trouble from it.
Hmm. But it is okay if you're like a new business owner, and we see so many that just started out kind of reinvesting everything back in the business just to get through that first couple of years. That's really tough. That's kind of okay, but just don't keep doing it.
It's okay in the really short term. You've just got to be really careful about how long that goes on because it's very normal, right? Your first year or two of a business, a lot of businesses don't make any money. So you're just living on your salary, and that's fine. But when you hit profitability, again, you're going to reach a point very quickly where the business does need to pay fair compensation for the work you do in the business. And it really doesn't matter what your occupation is, it needs to be fair compensation for what that occupation is, in light of the fact that not only is it your occupation, but also you're the business owner.
Hmm. Okay. Well, what about? I see new business owners do this same thing as well, where they'll take some of their personal money and then loan it to the business just to help it get off the ground in those, first year or so. Do you recommend something like that, or is that kind of too much mixing of business and personal?
That's a very normal business practice to go ahead and put your money into the business, right? Let's say you're going to start a restaurant. On day one of running a restaurant, you're going to need to have, all the kitchen equipment, the tables, the silverware, the glasses, the inventory, all the food, liquor, whatever you're selling. And by extension from that, also, you're probably going to have to hire, a couple of chefs, a couple of wait staff, a host, hostess, whatever it is, right? To be open 7 days a week or, as much time as you want to be open during the week. And so it's going to require a capital contribution into the business in the first place to get it off the ground. That's a very normal business practice. I think the challenge arises when you have unequal contributions into the business and what that ultimately says about what the owners of the business are doing. It's one thing if it's just your business and you're just putting capital into your business to make sure you can keep the lights on. It's a different thing if different owners in a partnership or in a corporate structure are contributing different amounts of the business and then getting paid differently based on their actual work in the business and getting paid different amounts of profits relative to what their ownership of the business is. That's where stuff starts to get messy.
Ah, and therein lies the importance of having contracts and official things signed if you're loaning money to a business with a partner.
I don't care if you run a lemonade stand in your front yard. I want to see an operating agreement or a partnership agreement. Like that's the level of this. So many businesses start with a handshake, and like that's awesome. That's the exciting sort of American spirit thing is banding together to create an enterprise and create a new thing or provide a new thing to a community. Like that's great. But the second you have a corporate entity structure of any sort or an LLC of any sort, or you have any partners, your contracts become law, and the absence of contracts becomes a problem. When you have business partners, you're getting married to the most valuable thing in your life and some of the people you spend the most of your time with, i.e., your business partners. And those contracts are going to dictate it. And just like getting married, everybody tends to go in with warm, bubbly feelings up front. But when the divorce comes around, it can get pretty nasty. So your operating agreement is super duper important in how you deal with those things.
Right. Always, always good to have one and revisit it regularly.
Yep.
Okay. Well, once they start to grow a little bit more, say we've made it through the first couple years as a business owner, we're doing great. How soon can they outsource things, like marketing and bookkeeping, which a lot of small business owners do themselves, especially in the beginning, but at a certain point, your time is more valuable elsewhere. How do you decide when that is?
So I think a really good framework for doing this is, and this is not my original idea. This has come. I've read about this in a bunch of different places. I've seen this in a bunch of different places, so I can't even attribute it correctly. But I just want to be clear: this is not my idea. But the basic thing is write down everything that your business requires, everything that you do as an owner, and then divide it into a matrix. Have stuff you enjoy and stuff you don't enjoy. Have stuff that you can do, and have stuff that only you can do. And you should really try to outsource the stuff that is a confluence of things you don't enjoy and things anybody can do, and try to outsource those as quickly as possible. And then as time goes on, you try to outsource the things that you enjoy but anybody can do, because at the end of the day, that's not the best use of your time. And then once you're down to only the things you can do, you try to figure out a way that somebody else can do those things and try to get rid of the things you don't enjoy. The other dimension of this is, other than don't enjoy, is not good at. So bookkeeping is an example you gave. Most business owners have terrible books. Most business owners tend to categorize their transactions incorrectly, not utilize software appropriately. And so that's a really common example of something people should outsource, because A, bookkeeping adds no value to their business unless they are literally an accounting firm or a bookkeeping firm. And secondly, it is just generally not, because it's not a value creating item. It's also something that's very easily outsourced, right? There's plenty of bookkeepers, plenty of accountants, et cetera. So that's a good one to go ahead and get rid of, particularly if you're not good at it and if it's not adding to to the value of your business.
That's pretty simple. How do we evaluate when it's time to start offering like retirement plans to employees or health benefits or something like that, the next phase of it all?
You've got to be at the point where your business can support and sustain it, because obviously if it's not financially feasible, it's not financially feasible. The state often, in many cases, like here in Colorado, if you have 5 employees, you have to either put them on a state employment retirement plan or offer them a retirement plan through your business. So there's regulatory triggers. If you have more than 50 employees, you have to offer some form of health insurance. So there's a lot of things like that come into play. But generally speaking, I think you want to start offering benefits as soon as it's financially feasible, because the thing is if you just pay hourly wages or small salaries or whatever it is to start, because that's all you can afford, that's reasonable. You have to remember that people work for a living. And so if your business really thrives and relies on paying people as little as possible and not giving them benefits, not giving them health insurance, et cetera, you're asking them to make up the difference elsewhere, whether it's through a spouse who has an higher income, whether it's through a family member that can offer them health insurance, whether it's through any number of other alternatives. But you're essentially saying that's not my problem, but it is your employee's problem. And some people will work for a long time without high wages or without benefits, but at some point there's going to be a push that comes to shove, and you're going to end up with an employee who's leaving because they need something you're not providing them with. So I think it's really important, particularly if you want to build a strong team with good tenure in your practice or in your business or your firm, you want to work on getting benefits in order sooner than later. The economics of that are very dependent business to business.
Right. Like I was talking to somebody this week and they were saying, we have a fairly small company, 10 employees, whatever, but we're wanting to be able to offer health benefits to them. But some of the employees don't want or need those because their spouse gets it or something. But the other people on the team do want it, and they were asking about QSARAs and things like that. How often do you recommend to like a smaller business doing something that's, I don't know if it's creative is the word, but a QSARA I would say is slightly more creative than just offering standard benefits?
So, for anybody listening, a QSARA is just the arrangement in which you're essentially going to pay your employees some tax-free money to go get their own health insurance or pay for their health insurance somewhere. So it's a step that happens before you have like a formal group health insurance plan where everybody signs up during open enrollment for a specific type of plan and so on. I think that's again, as soon as it's financially feasible, it's great. You also have to remember that there's a difference between, let's say, somebody being paid $60,000 a year and somebody being paid $50,000 a year, but also getting $10,000 in benefits with tax advantages. case by case here again, like you need health insurance, you need to save for your retirement, you need life and disability insurance, vision, dental, you need all this stuff. And if you don't have it through your employer, you have to provide it for yourself. And it's often going to be much more tax efficient to get it through your employer than it is going to be to do provide it for yourself and pay for it after tax with just plain wages. So again, I think any business that wants to drive strong recruitment, strong retention, et cetera, has to get on that stuff sooner than later. You don't have to do it all at once, but I hesitate to say it's not that expensive because in some businesses it's very expensive, but it is something to really take pretty seriously and look at closely as soon as you think you have consistent revenue to support it.
Right. And just team morale and stuff aside, employee retention is quite a bit cheaper than constantly having to hire and train people, I think, in almost all business models.
Well, and that's the big sort of return on investment from it is if you have really high turnover, you waste a lot of time recruiting and training and onboarding and so on. So there's a thing here where it's like, well, we're gonna have to spend $5,000 on this or $10,000 on this per employee per year. That's a lot of money. It's like, yeah, but how much money does it cost you to replace them? And often the break even there is pretty preferable to just keeping them in the first place.
Right. Very, very true. Okay, are you ready for another smooth transition, Dan?
Only if you can get there in 5 minutes.
Okay, let's talk about annuities.
All
How about
right, let's
that?
talk about annuities. What do we want to know?
First of all, I mean, there's a lot of variety in all that, and it can get fairly complex. So I'm not going to talk about this for an hour. But a lot of people, again, people I've talked to this week will bring an annuity in and they're like, yeah, I've got some returns. It's been growing. It's doing great. But then we actually look into it, and it's one of the biggest problems is there's a lot of hidden expenses and fees that they don't really know how to look up and find themselves. So, first of all, is there a way that these people can look up and calculate themselves how much they're actually paying for a product like this?
Yes, but it's very difficult, and I think it's also exceedingly difficult for the average consumer to know where to look in the first place. Annuities generally will often either have what quote unquote the cost baked in. So there are various annuities that are called single premium immediate annuities, where essentially just here's my money, start sending me a check. There's never an explicit fee on that type of annuity, like it's going to cost you 1% a year because you're just writing a check to an insurance company. You're never going to see that money again, but they're going to start sending you a check every single month going forward, every quarter, every year going forward. So the cost is baked in. Other examples are things like fixed indexed annuities, where again, there's typically no explicit fee being charged. You're never going to see it on your statement. But what they're doing is making money on essentially how your money is invested by limiting your potential upside, but also giving you certain guarantees against the downside. But the limits on the upside are sufficient that by doing so, they're able to essentially cap your profits. And by capping your profits, then they get to take anything that happens above and beyond that. In the case of variable annuities, that's where you're most going to commonly see actual fees and expenses. Specifically, what you're looking for is what's called an M&E, mortality and expense, or MENA, mortality expense and administrative charges. It's very common for these to be 1%, 1.25%, 1.5%, and that's just to have the annuity without any perks or benefits. And then there's going to be subaccounts. Subaccounts are essentially mutual funds, and typically, even if you see something like Vanguard in a variable annuity subaccount list, it's often going to cost something like 30 basis points or 0.3%, as opposed to Vanguard's normal 0.03% or 0.04%. So it's often going to cost substantially more than the mutual fund or ETF equivalent because there's often some profit being made in those sub account fees as well. So it's very typical to see the base cost of an annuity be north of 1%. It's very typical to then see the fund costs that you're paying for inside of a variable annuity be up to or close to another percent. And then if you want to buy guarantees, so guaranteed interest rates where like your annuity value will always go up by at least 5% every year, or they guarantee the value of your annuity on the day you buy it. And even if it loses value, they'll still pay you a stream of income based on its value, even if it loses value. In cases like that, you're often going to be paying another 0.5%, 1%. So it's not uncommon to see something like a variable annuity with an accumulated cost of like 3 or 4% in the marketplace. And so to your question, like how do you go find that out? When you buy one, you sign a thing saying you read the prospectus. Prospectuses are often kind of hard to find. They're supposed to give it to you in advance, but a lot of agents don't. And in those situations, you essentially have to Google it and really, really dig. And if you find yourself in a PDF that's like 200 pages long, you're in the right place. But recognize then that you've got to dig through that 200-page document to find all these costs and expenses and add it all up. I think the big challenge here is a lot of people say like, well, just ask your agent. The case you're thinking of from earlier this week, right? When we talked to her, she's like, "Oh yeah, they told me about the 1.6%, but they didn't tell me about the other 0.95% I was paying." It's like, yeah, because you asked them a question like, "How much does this annuity cost?" And they told you, "Oh, the fee for the annuity is 1.6%." They answered your question directly and honestly. They just didn't continue on to say, "But the investments you invest in through this annuity are going to cost you almost another percent on top of that."
Right. So they can be very, very expensive products for most people. But okay, so annuities you can add riders on. There's a long, long list of different ones that you can add. Are there certain ones that are more valuable than others, like the death benefit one or the guaranteed minimum withdrawal benefit? I mean, there's so many to choose from.
Provider by provider, there's definitely like a best guaranteed minimum benefit and a guaranteed best death benefit and guaranteed best accumulation benefit, but it's going to vary carrier by carrier and policy type by policy type. There's no singular annuity out there that has like the best feature of every single type that you can buy, and that's sort of the crux of the issue. Is ultimately you've got to research and find a product that actually fits your particular planning needs.
Like I always see a lot of people that maybe can't get underwritten for like a long-term care policy, so they'll get an annuity with a long-term care policy rider on it, something like that.
So that's a pretty common example. You don't see those as much in VAs, but you see those in some of the fixed products out there. But also things like, hey, I want an interest rate guarantee on this policy. I'm willing to pay a couple percent a year, knowing that I'm likely to underperform the market generally. But that way, if the market really tanks, really crashes badly, I've got a floor in place and I've got some guaranteed interest, so that even if my actual contract's value declines, the contract has some guarantees in it that preserved the value as of when I got invested, or year over year on a resetting basis, to ensure that even if I lose money in the markets, I've got some security for my savings. That's really the value proposition for an annuity, because you have to remember an annuity is an insurance product, and the insurance product or the insurance risk that it is trying to insure against is the risk that you're going to run out of money someday.
Right. Okay. Well, final kind of question on this subject. If you have an annuity and you've looked through it and realized that you're overpaying or it's not a good deal, how do you get out of it? There's surrender fees and there's these schedules, and it seems very daunting to people who maybe don't know what they're looking at.
So one way that you can avoid at least some tax ramifications, depending on the type of annuity you have, is you can do something called a 1035 exchange, where you can at least exchange from maybe an expensive annuity to a much cheaper annuity. That's one option. The alternative is you do have to surrender. A surrender, if it happens in the first 5 to 10 years, is often going to come with a surrender charge that's going to be often something like the number of years of surrender. So if the surrender period is, let's say, 8 years, it might be 8% the first year, 7% the second year, 6% the third year, and so on. And then once you get past the surrender period, there's no fee or charges anymore. I don't like incurring surrender charges because we're just spending money and it all goes to this agent's commissions and recouping the company for paying the agent a commission. That's really what it's there for. But on the other side of that, the costs of many annuities are going to be so excessive that avoiding something like a 1% surrender charge might cost us 3 or 4% in additional fees for the next year. So that's where you want to really look at a break-even analysis and understand, if I stick it out until the surrender period's over, how much is it going to cost me, versus just ripping off the Band-Aid, getting out, taking the penalty, and getting my money somewhere that's better for me.
All right. Very exciting, uplifting topic to end our podcast.
It is, and congratulations, you ran out the clock, so today I don't get to ask you any questions.
Oh no, the most exciting part.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.